All right, good morning, warriors. We have kind of done the part B of the whole topics, right? We have done what is called as your MAT computations and all those things. We are moving on to part number C. This is more specific related provisions which happens in case you're opting for one specific entity to compute your total income. Yes. We're starting with the first entity, people, which is called as firm. Now, for those who understand this carefully, if you get a question in firm, people, to normally be a total income question along with something called AMT. You don't get MAT when it comes to firms. Firms get something called AMT. Yes, but when it comes to firm also, people, let's also bear in mind that when it comes to firm, there are some special provisions, especially with the amendment of the current year. First rules to follow when it comes to firm, people, is that you need to understand what is the transaction which takes place between the partner and the firm. Yes, there are three kinds of transactions which can take place between a partner and a firm. Transaction number one talks about share of profits, where income tax comes and says if it is share of profit, it is not allowed as reduction in the hands of firm, but it is exempt in the hands of partners. Yes, because the partnership firm is already going to pay tax on the whole income. It is exempt in the hands of the partner because firm takes care of the taxes. Yes, that is your transaction number one. Then comes your transaction number two, which talks about interest, where income tax says if there is any loan or capital which is given by the partners, then that can be allowed for an interest of 12% per annum, will be allowed as an interest of 12% per annum in the hands of firm. Because it is allowed in the hands of firms, it now becomes taxable in the hands of partners. People, what is allowed in the hands of firms becomes taxable in the hands of partners. If you exempt both the places, it becomes an issue. Yes, so therefore it is deductible in the hands of firm, therefore becomes taxable in the hands of partners only to the extent of 12%. So if a partner is paid 15% of interest, the firm will disallow 3%, and therefore that 3% will become exempt in the hands of firm. Yes, exempt in the hands of partners. Then comes rule number 3, which talks about salaries. For you to start paying salaries itself, some rules to satisfy, people. Rule number 1, there should be a deed. Rule number 2, the deed should confirm there is a salary payout. Rule number 3, salary can only be paid to working partners. And rule number 4, the salary can only be paid prospectively, cannot be paid retrospectively. For this to happen, people, income tax comes and says, first, for you to compute salaries, first tell what is your book profits. This book profit is not the same as MAT computation. This book profit means your actual PGBP income, excluding only one item, which is salaries. So take your old PGBP computation, people, remove only the salaries which is debited to P&L. You'll arrive at something called as book profits. But yes, people, a small adjustment to be made. You also have to claim something called as unabsorbed depreciation, unabsorbed capital expenditure on scientific research, and unabsorbed family planning expenditure. This alone will be reduced for the purpose of computing book profits. Once you finalize what your salary computation is, you can add it back. You can only allow this after you have set off your current business losses, your current depreciation, and your past business losses. Yes, so for the purpose of book profit alone, you will reduce this, and then later on you will add it back and then take it later. Yes or no? Yes, once you compute a book profit, people, income tax says do one thing. For the first 6 lakh rupees, you can pay a salary of 90% of the 6 lakhs or the actual book profit, whichever is given, or 3 lakhs, whichever is higher. Here it is higher, people. So it is 90% of the book profits or 3 lakh rupees, whichever is higher. For the balance book profits which you have, people, you can only pay 60% of the book profits. You now get the total salary which can be paid. Compare this with your actual salary, whichever is lower. This is the final salary which will be paid out. This will be the final salary which will be paid out to your partners. This will be allowed as reduction in the hands of firms and therefore will become taxable in the hands of partners. For you to do this also, people, income tax says something called as representative capacity and individual capacity. Income tax says that if you are going to receive salary in individual capacity, even if you receive salary in representative capacity, they both will be added together. You cannot look at them independently. However, the same rule does not apply for interest. Income tax says if you give a loan or a capital in personal capacity, whatever loan you give in representative capacity will have separate parameters. You will not apply 12% of interest on those components. Yes, so if I am a partner in the firm, my HUF giving a loan will not be restricted for 12%. For them, the rules of 48(2) will apply. And therefore you can give interest up to market values, but the same is not true for salaries. If I am getting salary in my personal capacity, even if I get salary in HUF capacity, they both will be taken together for the purpose of my salary computation. Yes or no? Yes, we discussed with some examples, people, where I told you I am a partner in the firm, I am also a HUF member. If the HUF is working for the firm and the HUF is paid salaries, it will still be added to my salary and therefore will have an overall restriction. But if I give a loan to the firm and my HUF also gives a loan to the firm, then my loan will be triggered for 12%, but HUF's loan will not be triggered for 12%. That will be subject to 40A2 rules. Yes or no? That is the trigger point, people. So therefore, what you need to do, you need to take your limits, you compute your book profits. When you compute book profits, only disallow the actual salary which is debited to P&L. The item above that, people, the interest is just clarifying, saying interest is only allowed to 12%. If it is more than 12%, you can disallow that off, as simple as. Yes, after that, people, they come and say, when individual is a partner in a firm, then in representative capacity, whatever interest he gets will be allowed as deduction with no restrictions, and in his individual capacity, whatever he gets will be subject to 12% of limits. Representative will not be triggered on it, but this is only for interest, not for salaries. Rule number 3, people, income tax also comes and clarifies, or probably the case laws are now coming and clarifying, saying when it comes to payment of salaries, it is not mandatory that you need to mention in the deed as to what salary you will pay. You can also write a general caveat saying you can pay whatever is allowed as per income tax, even if you mention that, that is also still covered. But yes, people, one thing to be checked from an exam perspective is, in exam perspective, any payment coming to you is a part of salaries, If the question comes and says that Rahul is a partner and Rahul has given you a copyright for which you are paying me royalty, people, is that part of salary component? Yes, it will. It will also be a part of salary component. Income tax comes and clarifies, any payment given to the partners other than interest will be called as salaries. So this is one thing which ICAI has tested on multiple occasions, people. Please be mindful of this one. Yes, any payment coming to you, whether it is for your personal items also, it is still a salary as long as it is not interest. So that also has to be taken into consideration. All other provisions, people, where they are coming and clarifying, if you want to be assessed as a firm, some rules to be followed. Rule number 1, there should be a legal instrument, basically a partnership deed. Rule number 2, the share of profit must be specified, because if it is not specified, it becomes AOP or BOI. Third, a certified copy of the instrument should be furnished along with the first year of return to the assessing officer. Rule number 4, in case there is a change of constitution, then the revised document should also be submitted to the officer. And finally, the firm should not commit any default which is under section 144, which is your best judgment assessment, meaning I should always comply with assessment procedure. Any default here, people, you will automatically be termed as a AOP and a BOI. You'll automatically be termed as an AOP or BOI, which means you will now become taxable at maximum marginal rates, and whatever salary and interest which was paid to the partners will become fully disallowed in the hands of the entity, and therefore will become fully exempt in the hands of the members. Yes or no? Yes, that is what the rules come and say, clarify. Second, people, when it comes to change of constitution, succession and all those things, income tax is coming and clarifying, when there is a change of constitution, meaning there is just an addition or retirement of one or more partners in such a way that the firm is not dissolved, the assessment on the firm will continue as it is. However, people, for all the firms which have losses, the partner who exits will have an issue, because the firm will now take a proportionate disallowance of the loss. We discussed about it, people. Yes, when it comes to losses, if a partnership firm has a partner leaving, whatever losses are there in the firm will be automatically denied to you, to the extent of the partner's share, unless and until the change in constitution is happening by way of succession, meaning transfer is happening by way of will or something, Second, people, if a succession completely takes place, meaning all the partners have exited but the firm is continuing, in that case, what will happen? Assessment will happen in the name of new firm. With the new partners. But in case there is a dissolution or discontinuance of business, people, then in that case, the assessment will continue as if the firm was never dissolved until the assessment gets a closure. Here is where your general rule of basics of income tax will apply, people, because the business or profession is being discontinued. The previous year and assessment year will become the same. Assessing officer will only let you dissolve after the assessment process is completed. After the assessment process is completed. So here they are coming and saying, I will do assessment as if the entity was never dissolved. As if the entity was never dissolved. And finally, like I said, people, when it comes to carry forward losses, if there is a change in constitution, then the losses will get lapsed automatically unless and until the change is happening by way of succession. However, this is only applicable for losses, not applicable for unabsorbed depreciation. People, in the whole losses chapter, like I clarified earlier, unabsorbed depreciation is not covered except for one place, which is amalgamation and demerger. That is the only place where there is a restriction on unabsorbed depreciation. Everywhere else, even if the rules are not satisfied, unabsorbed depreciation can be carried forward. The only place where you need to satisfy rules are amalgamation and demerger, because there, if you don't satisfy the rules, it will lapse even for unabsorbed depreciation. Yes, so that is one thing to be kept in mind for always, people. Wherever you see losses chapter, if any default happens, it still does not matter, because unabsorbed depreciation will continue carry forwards unless and until it's a case of amalgamation and a demerger. Yes, what are the miscellaneous provisions? Like we discussed, people, when it comes to partner share of profit, it is fully exempt in the hands of partners. Conversion of private company or unlisted company will not be regarded as transfer. Any kind of partner will be jointly and severally liable for all the taxes which is due in the firm. He cannot plead that he is only liable for certain share of profits. He will be liable for the whole default. But yes, he will also be given right to collect the money back from other partners. He has that inherent right with himself. Yes, and finally, even in case of LLP, every partner during liquidation will be jointly and severally liable for all the tax and payment defaults, unless he can prove that the non-recovery is not because of his negligence. Basically, in this whole income tax, people, income tax says limited liability as a concept is not there. Every partner and every director of a private company is fully liable even for not his share, unless he can prove that he is not negligent. Yes, meaning in income tax they say if you're negligent, then you're liable unlimited, but if you're not negligent and you can prove you are a genuine person, then it's a limited liability. That is what the provisions are coming and clarifying. Yes, a case law for you to keep in mind, people. Income tax comes and clarifies where an remuneration is paid to a partners and it is within the limits of section 40B. The assessing officer cannot contend of section 48(2) to come and say it is unreasonable. When income tax itself is telling you how much salary to pay, you cannot come and defend using section 48(2). That is not how it works. You only follow one section. You cannot contradict two sections. Some special adjustments from total income perspective, people, which we discussed earlier also, that when a royalty is paid to partners for services provided to the firm, it will still be taken as salaries. Even if you give a copyright, it doesn't matter, because you are a partner of the firm. All payments given to you are salaries. Second, where the question specifies that the remuneration alone is authorized by the partnership deed, people, inherent assumption will be only remuneration is authorized, meaning interest is not authorized. The moment it says that, it means interest will be disallowed. You cannot claim that interest as a deduction. Yes, so watch out for what is happening in the question very carefully, people. And finally, they come and say question only specifies that interest on authorized capital is authorized, in which case you have carefully used the word interest on capital. They have not used the word current. In a question, people, if you get a fixed capital and a current capital, don't give interest on current capital, only give interest on fixed capital. Again, watch out for the question, how does the balance sheet look like? Yes, so in case of partnership, people, there is nothing much to discuss from a total income perspective. Just focus on what the English is given. The English will make a difference. Three things which have been tested multiple times when a partnership firm comes. One, they will come and give that the interest or salary or whatever is only authorized, meaning other items are not authorized. Second, they'll come and say that the partner is having a special intellectual property in his name and he gets royalty from the firm. That is still covered. Third is that you will get a question where they'll come and say that the firm is planning to dissolve. And they'll give you the inventory value. One at cost and one at NRV. For those who remember ICDS provisions, people, ICDS comes and clarifies when an entity is being dissolved, inventory will be valued at only NRV, unless no rules, only NRV is the condition, people. Normally inventory is always valued at cost or NRV, whichever is lower, but if the entity is getting dissolved, it will only be valued at NRV, even if NRV is higher. It doesn't matter. You will value at NRV and the extra profit will be added to your computation. will be added to your computation. This is one adjustment which has come multiple times, people. So please pay attention to that. Yes, yes. When you have what? When you have what? You have a dissolution taking place. Inventory will always get valued at NRV, even if NRV is higher. Even if NRV is higher. Clear? Yes, yes. This is your assessment in firms and LLP, people. Any doubts on this? No. Expect a question at least from an MCQ perspective on the book profit computation, because there is an amendment on this. Yes, I don't expect this to come in inter because it is not tested multiple times. Chances of it being tested in final level is more likely. If you get a question on firm, you will definitely get a question relating to AMT in the, yes. So you'll have 35 adjustments, you'll have 35 AD adjustments, you'll have 80 JJAQ, QB, RRB, or 10 AA inside it, or 10 AA inside it. So a firm question will get triggered along with AMT related questions, so please be mindful of that. Yes, yes, yes. Moving on forward, people, to something called as AOP and BOI. Now from an exam perspective, AOP and BOI has not been tested very significantly. I am going to look at it not from the perspective of the entity, I am going to look at it from the perspective of the members. So let's focus from the perspective of members, people, because you may get a question relating to double taxation relief. Yes, that is what the provisions of AOP and BOI are. Income tax is basically coming and saying when it comes to AOPs and BOIs, when it comes to AOPs and BOIs, the members can only be receiving something called share of profits. The members cannot receive any other remunerations or interest. So any remuneration given to the AOP is fully, remuneration given by AOP is fully disallowed. Any interest given by the AOP is also disallowed, and therefore is fully exempt in the hands of members also. Members can only receive something called as share of profits. Now coming to AOP and BOI, people, income tax comes and says two things to be satisfied. One, there should be an instrument. An AOP or a BOI deed. An AOP or a BOI deed. And second, the instrument should come and clarify who is the member and what is his share of profits. Rules are to be followed. Income tax comes and says if you are having a deed and the deed comes and clarifies what the share of profit is, meaning the share of profit is known. In that case, I will ask you a very simple question. Tell me how much of the members are having income more than basic exemption limit. How many of the members have incomes more than basic exemption limit? If the incomes of any member exceeds basic exemption limit, the entire income of the entity will be taxable at MMR, which is 42.744%, Although yes, people, be watching out for the fact that in case the question comes and says AOP is a default tax regime case, then it will not be 42.744, people, because the surcharge itself is restricted at 25%. So it will not become 30 plus 25 plus 4. It will become 30 plus 25 plus 4. It will not be 30 plus 37 plus 4. Watch out what does the question say with regards to AOP or BOI. If they come and say no, all the members are below basic exemption limit, then the income tax comes and says AOP will compute tax at slab rate models. Whereas on the right side, people, if you very clearly come and clarify that none of the profit sharing is known, income tax will say great, then take the income and tax at MMR directly. However, whatever income you're taxing at MMR is only slab rate incomes, meaning all incomes which are anyway taxable at special rates like capital gains, winnings, online winnings, and all those things will continue to be taxed at those rates. Meaning slab rate will change to MMRs. In two cases. One, either the profit is not known, or even if the profit is known, the members have income more than basic exemption limit. Here to be mindful, people, that even if one member's income goes more than basic exemption limit, the whole entity is paying tax at MMRs. That is what the rules are. Yes, but income tax also comes and clarifies, people, if the member is not, if the AOP is already paying tax at MMR, the member becomes exempt from the share of profits. The members become exempt from share of profits. However, if the AOP is paying tax at slab rates, then the member will become taxable for it, but will get a relief, or as we call it, rebate under section 86. This formula is the same as double taxation relief formula. You have to do nothing, people. Take whatever money you have received from the member and compute your final tax payable. Then divided by total income to arrive at your average tax rate. This average tax rate will then get multiplied by the money which you receive by the AOP will get multiplied by the money which you receive by the AOP, and therefore that will become your rebate money. That will become your rebate money. For example, people, if a question comes and says that you have received, let's say, 10 lakh rupees from AOP, you have received 10 lakh rupees from AOP, and you have 20 lakh rupees of your personal income, of your personal income. Your total income becomes 30 lakhs. First step, compute tax on 30 lakhs. Compute tax on the whole 30 lakhs. You will arrive at a tax number, people. You will arrive at a tax number, assuming hypothetically the number is 10 lakhs. Assuming hypothetically the number is 10 lakhs. Step number 2, tell me what is the percentage of tax, which means 10 lakhs divided by 30 lakhs. 10 lakhs divided by 30 lakhs. In my case, the case becomes 1 by 3, 33.33%. Yes. Step number 3. Step number 3. It is percentage into AOP share. It is percentage into AOP share, which becomes your 3.33. Therefore, final tax payable is 10 lakhs minus 3.33, arriving at 6.67. Arriving at 6.67. This is how the computation will work, people. Yes, simple, straightforward case, people. Just compute the full final tax liability, arrive at a percentage. That percentage is what you will claim as rebate. That is what the understanding is. Yes or no? Yes or no? This is what the final computation is when it comes to AOPs and BOIs. Clear enough? Are we good to go? Yes, yes. What are the rules are to be followed, people, when it comes to AOPs and BOIs? Rule number 1, the income tax is coming and clarifying. In case of dissolution or discontinuance of an AOP, every member of AOP and legal representative will be jointly and severally liable for all the money which is due from the taxation thing. You cannot defend about the fact that the entity is closed and I don't have a share of profit. Yes, here also the same rule will apply, people, as basics of income tax, where an AOP or BOI is discontinued in the previous year, your PY and AY will become the same. Your PY and AY will become the same. Yes, rules of AOP of case law, people, where they're coming and saying just because 2 or more people are coming together for a common purpose does not automatically establish an AOP or a BOI. For an example, if the father dies and gives the property at will to his kids, if the kids together go and sell the property, does not automatically make AOP or BOI. They are still selling in their personal capacity, which means the share of profits will be split over each person in their individual nature. This will not automatically assume a AOP or a BOI model. Yes, for something to be established as an AOP or BOI, we should have a common intention to make profits. We should have a common intention to make profits, or it should be forced by the law. Yes, just because you are forced by someone else to bring it on, that does not make it a AOP or a BOI. Clear? Yes, yes, great. After this, people, we are going to hold back on the charitable point. We are moving on to something called as your other areas, people, which talks about special trusts. You can answer this whole thing from this chart alone, people. You don't need to go through the topic. We are looking at what is called as business trust. Income tax comes and says when it comes to business trust, people, there are 3 entities involved. One is SPV, the one who will give the money. Second is business trust, the one who is collecting the money. And finally, there is investor, the person who will receive the money on his investments. Yes, so 3 things are given to you, people: SPV, business trust, investors. Income tax comes and says, boss, whatever money is received from the SPV to the business trust is exempt. This will only be taxable in the hands of investors. We call it a pass-through entity. Except for one item, which is dividends. Provided the dividends are not taxable for the SPV under special tax regime. Basically, people, if the SPV is paying tax as per normal rates of 25 and 30%, then whatever dividends it gives to SPV is exempt. Whatever dividends gets from SPV to the investor is also exempt, meaning dividends are only taxable in the hands of investors if SPV is opting for special tax rates. Yes. Yes, yes. So when you get any kind of dividend, people check whether the SPV is paying tax as per normal rates or as per special rates. If the SPV is paying tax as per special rates, then it is taxable in the hands of investor. If it's paying as per normal rates, it's exempt for everyone. It's exempt for everyone. Any interest received from SPV will be exempt for the business trust, will become taxable in the hands of investors. Apart from this, people, whatever money business trust earns, will be taxable in the hands of investor, like rental income received from properties, will become taxable in the hands of investors. Other than that, people, any passive incomes earned, normal interest and all which is earned by the business trust will continue to be taxable in the hands of business trust. In simple words, people, three incomes are going to be taxed in the hands of investors: interest received from SPV, dividends received from SPV if SPV is paying tax at special taxes, and rental income earned by business trust. These are the only three incomes which will be taxable in the hands of investors. Every other income, if at all is there, will be taxable in the hands of business trust itself, provided they are passive in nature. Yes or no? Yes. For this to apply, people, income tax is coming and saying before the transfer happens from the business trust to the investor, please deduct TDS. What TDS will be done, people? If the person to whom you are giving the money is a resident unit holder, then you will deduct TDS at a standard rate of 10%. Whereas if it's a non-resident investor, people, then you will deduct at 5% for interest, rates in force for rentals, and 10% for dividends. 5% will become 4% if it is located in IFSC. Before 2023. That is what the rules are. Yes or no? Yes. On the contrary, people, looking at from the perspective of the investor will continue to pay tax as per their normal rate. So if it's a resident individual, they'll pay tax at slab model. If it's a non-resident, then we have special tax rates the same as TDS, which means interest will become taxable at 5%. The rental will become taxable at slab rates, whereas dividends will become taxable at 10%. Again, people, 5 will come down to 4 where the investment is happening in IFSC before 2023. At the same time, people, income tax is also coming and clarifying that when it comes to other incomes you will have to classify it taking as special income or other incomes. If it is special income in the nature of 111 or 112, then you will tax it at the special rates of 20% for 111 after 23rd July and 15% before 23rd July, 112 in the 12.5% after 23rd July, and 10% before 23rd July in excess of 1.25 lakhs. All other incomes getting flat taxed at MMR are getting flat taxed at MMR. Yes. Summarizing this whole topic once again very quickly, people. In the hands of SPV, nothing is there. In the hands of business trust, exempt items are interest from SPV, dividends from SPV, rental income from rental properties. Apart from these three, anything else received is fully taxable in the hands of business trust. In the hands of unit holder, items which are taxable is dividends if SPV pays special taxes, interest received from SPV, rental received from the properties. Rental is always going to be taxed at slab rates, so TDS also happen at slab rates. Dividends will be taxable at 10% in case of non-residents and slabs in case of residents, but TDS will remain the same for both TDS are 10%. Coming to interest, people, it is 5% for non-resident and slabs for resident. TDS for residents will always be 10%. Like I told you earlier also, people, when you don't know the TDS rate, it is always 10% only for residents. Non-residents will change. That you have to remember. Yes or no? Yes. Next, people, the amendment of the current year, and the crucial amendment of the current year which comes and clarifies when you have units of business trust, transferring units of business trust will have a period of holding of revised 12 months. Provided the transfer takes place after 23rd July. If the transfer takes place before 23rd July, period of holding will be 36 months. In order to classify them as 112A. If not, it becomes 111A. That is what the rules are when it comes to business trust. Yes. Last thing to be kept in mind from an exam perspective, people, all money which is received by the business trust will become taxable in the hands of unit holder, even if the business trust has not distributed the profits in the current year. Questions will come in exam where they will clarify saying business trust out of 10 lakhs has only distributed 8 lakhs. They have not distributed 2 lakhs. In that case also, the full 10 lakhs will be taxable in the hands of investors. You do not exempt anything, because income tax assumes whatever money is there on 31st March is assumed as distributed to the investors, will be distributed to the investors. That is what the rules of business trust. Rules of business trust. Any doubts on the rules? Clear enough to go? Yes. Then comes in our next entity, people, which is your securitization trust. The topic of securitization trust is very simple, where they simply come and say whenever there is income from securitization trust, it becomes exempt in the hands of trust and becomes taxable in the hands of investors. That is what you have to remember. Yes, TDS will happen at a very simple rate. They come and say TDS will happen for resident individuals at 25, for other people at 30, and for any non-residents it will happen at slab rate model. The one thing to be kept in mind, people, in an exam perspective, non-resident taxation, you will get a question on this, and if you get a question, please always apply surcharge and cess. Don't miss the surcharge and cess even on TDS. We discussed this earlier also, people. When a payment is happening to a non-resident, it is always done including surcharge and cess. So that has to be done always. Yes. Coming to what is to be invested, people, they are coming and saying whatever transfer is happening from the securitization trust to the investors has to be declared to the income tax department. The declaration should happen by 30th June to investors and 30th November to the officers. That is what the provisions come and say. Everything else remains the same, like we discussed, people. Even if money is not distributed on 31st March, it will be assumed as distributed on 31st March. Yes. And then your final topic, people, is your alternate investment fund. Income tax comes and says when it comes to alternate investment funds, people, only PGBP becomes taxable in the hands of AIF. All other incomes will automatically be taxable in the hands of investors. So income tax says investment funds, whatever money is received by investment funds will be fully taxable in the hands of investment fund, unless it is your PGBP income. So only transfer item here is PGBP income, which gets transferred to your investors and becomes taxable in the hands of investors. Yes, that is what the rules are coming and clarifying. That is all you need to keep. Whatever PGBP income is earned by the investment fund will be taxable as per the same rates as what the company and the firm have. Meaning company will have tax of 25 and 30, firm will have a tax rate of 30, and everyone else gets a tax of MMR. Will get a tax rate of MMR. If any money is distributed to the shareholders or unit holder, TDS will happen on resident at 10% and for non-resident at slab rate model. Again, all these things have to be distributed and informed to the officers by 30th June and 15th June. One thing to be kept in mind, people, only for securitization trust, the income tax department has given an extension till 30th November. For business trust and for AIF, the extension is only till 15th June. That is what the rules are. Securitization trust alone gets 30th November, everyone else gets 15th June. Yes. Finally, people, income tax also comes and clarifies when you are transferring profits to your unit holders, you can also transfer losses. But losses will not be losses from PGBP. Losses will be losses from other items. Yes, because PGBP is anyway going to be claimed by investment fund. So PGBP will be taken in the investment fund and PGBP will be addressed as per investment fund. Any other losses which the AIF makes will be transferred to the shareholders. But before transferring, please follow the rules of set-offs. Meaning, if you have a PGBP income and you have any other sources losses, that will first get set off against PGBP income. Only the remaining loss can be transferred to the unit holders. Don't automatically transfer. First follow the rules of set off in the hands of AIF, and if still there is any remaining losses, it will get transferred to the unit holders. But to transfer, people, the rule is that income tax says the investment should be there in the AIF for at least 12 months. If the investment is less than 12 months, income tax will not permit the loss in the hands of unit holders. Yes or no? That is what the provisions are. Yes. Finally, people, the amendment which came in case of business trust, people, the amendment which comes and clarifies if money is given to the investor, which is neither taxable in the hands of business trust nor taxable in the hands of investor, like we called it as repayment of loan in classes. Income tax has come and clarified if any such money is transferred, then that also becomes taxable in the hands of unit holders under the head IFOS. It becomes taxable in the hands of unit holder under the head IFOS. Income tax says any other sum which is received by a unit holder from a business trust which is exempt in the hands of unit holder also and is exempt in the hands of business trust also, then start taxing it in the hands of unit holder under the head IFOS. The only item which right now people have understood is repayment of loans. Repayment of loans. So income tax is coming clarified. Whatever repayment of loans you have will be taxable in the hands of unit holders, will be taxable in the hands of unit holders. This has not been tested in May and November 2024, but was an amendment of last year. I want this to be kept in mind for current year. For current year, expect a question on this. Yes, although even ICI is a little unclear on how they will draft questions on this, but it is what it is. It is what it is. They can give you a random thing. They can come and say this item is not taxable in both the hands of unit holder and business trust, then say it is taxable in the hands of unit holders under the head IFOS. Under that IFOS, that is what your rules are when it comes to your alternate investment fund, business trust and securitization trust. Couple of other things, people, from political party perspective, income tax is coming clarifying. When it comes to political parties, all incomes which are received by political parties are exempt, provided some conditions are satisfied. Condition number 1, they should maintain books of accounts. They should get records of each contribution received in excess of 20,000 rupees. Should not receive any donation exceeding 2,000 rupees in cash. Should get a report from a CA for all these things. Whatever books they have to be maintained by a CA and audited by a CA, and they have to mandatory every year file a return of income. If any of these conditions are not satisfied, whatever profits are received by the political party will become fully taxable, The one thing which my gut feeling, people, and maybe asked in the current year exam, is something relating to electoral trust. Yes, because a huge hangama happened on this in Supreme Court last year, and therefore I say I would love to take this opportunity to ask you questions on this. Yes, the one thing to be kept in mind is something called electoral trust. Now I don't know how ICA will ask, because technically electoral trust right now has been banned in India. They have completely been banned in India, but provisions still remain in income tax. Yes, provisions of electoral trust comes and says that when you have an electoral trust, people, the whole money which is received by the electoral trust will be exempt from tax, provided 95% of whatever money they have in their hand is distributed to political parties. Now when you are distributing, it is not 95% of the current year donation alone, it is 95% of current year donation plus any surplus pending of past years. This full money has to be distributed to political parties. If it is done so, then it is fully exempt in the hands of electoral trust. Otherwise, this money becomes taxable in the hands of electoral trust. For electoral trust to not be taxable, people, some other conditions to be satisfied. They can only receive contributions from Indian people. Getting money from foreign parties is prohibited. Rule number 2, whatever money they give should have details against it. Details like name and address of the person who's giving, the PAN number of the person who's giving, when did they give, what is the amount they gave, the mode of way they gave it to you, what other details you should be giving to that person. You should be giving your name and PAN, your date of approval from the income tax department, and the person who's authorizing this trust, the person who's authorizing this trust. These information have to be given to you. Other information are not very critical from exam perspective, people, but these couple of rules to be followed. Electoral trust exempted from tax, provided they distribute 95% of the donations they receive plus any surplus of the past years. This money should be distributed to political parties. Yes, and whatever money is distributed to political parties automatically become exempt, provided they maintain books. They get money by permissible modes more than 2,000 rupees. Details of all contributions exceeding 20,000 are recorded, and you get a CA certificate. Maintain your books, get them audit, file your returns. This is what the rules are when it comes to political parties. Yes. Leaving you with the last topic, people, the miscellaneous topics of other provisions. In this, the only thing which I focus attention on, people, is something called mutual concerns. Where income tax is basically coming and telling, boss, if you have created a cooperative society, where the intention of the cooperative society is only to support its own members, whatever money is circulated within the cooperative society is fully exempt from tax. Income tax basically comes and says entity cannot make profits from itself. So money received by the members from the cooperative society, from the money invested by the cooperative society, is fully exempt from taxes. At any appropriate stages, Supreme Court has come and clarified there should be no involvement of third parties. Meaning, for example, if you take the members' money and you put that money in a bank, and the bank gives you interest, this interest is fully taxable, because now you have involved a third party. Will not be exempted from taxes. will not be exempted from taxes. Even if this money is used for the purpose of the benefit of the cooperative society, it still does not matter. It is fully taxable. It is fully taxable. Yes or no? Yes. So for a cooperative society to be exempt from tax, money should be received from money should be received from members. Money should go out to the members. No one other than these people should be involved. If that condition is satisfied, you will exempt whatever money is received. Examples would be getting membership fees from the members, getting entrance fee from the members. All these money received from the members are used for the purpose of members benefit and therefore is fully exempted from tax. At the same time, people, income tax also comes and clarifies, when you give money to your members, please don't make any commercial transaction. If you are going to start selling them at commercial nature, then it is fully taxable under the head PGBP. Under that PGBP charging section comes and says transfer to members at commercial values are taxable, meaning whatever you are receiving should be given to members at no profit, no loss. No profit, no loss. Starting to make profits from the transaction will automatically make you taxable under this head also. Yes, so that is what mutual concern basically comes and says, people. When you have any kind of mutual concerns, these are fully taxable. Some case laws for you to follow. Any kind of transfer charges, non-occupancy charges, contribution to common amenity fund is not taxable in the hands of cooperative society because they have doctrine of mutuality. Yes, money is received from the members, money is given back to members. Transfer fees collected by the cooperative society from its incoming and outgoing members does not contain any element of trading or commerciality. Again, I am receiving money from my own members, which is going to be used back for the benefit of their own members and therefore fully exempt. However, where any surplus fund was invested by the members by the club in an FD and the interest is earned out of this FD, the such interest cannot be satisfying the principles of mutuality. Even if you found out that the bank is a member of the fund as well. Even if the bank is a member of the society, it is still not covered because people understand whatever money you put in the FD, the bank is going to use the money and do commercial transactions, meaning the money has left the vicinity of the cooperative society and therefore will not be eligible for exemption. This interest income will continue to be taxable under the head IFOS. Will be continue to be taxable under that IFOS. You have put interest in FD, it's a IFOS income. Yes, however, also bear in mind, people, because it's a cooperative society, you can go back to section 80p. You can go back to section 80p and claim a deduction of 50,000 rupees. You can claim a standard general deduction of 50,000 rupees will be allowed as deduction to you, unless you are a consumer cooperative society which gets 1 lakh rupees, This is another sources income and therefore will be allowed for a general deduction under section 80p. Cross reference here, people. Yes. Finally, people, you have other items like your insurance business and all, where they're coming and clarifying. If it's an insurance business, it is taxable at 12.5% on normal things. If it is a life insurance business, anything else will be taxable at normal rates. Please note that when it comes to insurance business, while IRD may be applicable, you will compute taxes same as PGBP rules, meaning if you have normal PGBP rules, follow the same rules. Will not be tested in exam, but good enough for you to know. Yes, that is what the provisions are when it comes to your special entities. So therefore, we have AOP, we have firms, we have business trust, securitization trust, alternate investment funds, political parties, and then something called cooperative societies.